Welcome back to the Deep Dive. Today we are tackling a question that's really evolved over the last decade or so. It's gone from this niche thing people talked about online to, well, a major boardroom discussion point. The question is Bitcoin BTC truly a safe investment?
It's a fascinating question because the narrative has shifted so dramatically.
Right. When Bitcoin first popped up, it was easy to write it off as, magic internet money, kind of a joke almost.
Exactly, but look where we are now.
Fast forward to today, and suddenly we've got regulated spot ETFs trading huge volumes. We have major corporations holding billions in BTC on their balance sheets.
And even nation states integrating it, like El Salvador.
It's achieved this status that, well, many analysts are now calling it an institutional-grade asset.
Which is quite a statement.
So our mission today is to cut through all that noise, look at the actual data, the sources we've gathered, and really figure out what safe even means when you're talking about something like Bitcoin, a decentralized digital asset.
And that's the core tension, isn't it? The inherent contradiction we need to address right up front.
Which is?
Well, this growth into something institutions are comfortable with is happening against this backdrop of, frankly, massive price volatility.
Huge swings.
Swings that would just immediately disqualify any traditional asset from being called safe. And then you layer on the history of major exchange hacks.
MGOX, FTX. The list goes on.
And the constant, complex regulatory battles happening all over the world. All of these things really cloud the picture when you try to assess its safety.
So our mission is clear then. We're going to unpack what safe means specifically for Bitcoin.
Looking at both sides.
Exactly. We'll analyze the very real risks in the ecosystem,
Right.
but also juxtapose those against this almost unprecedented resilience of the underlying technology, the protocol itself, that our sources keep highlighting.
It's a deep dive for sure.
Okay, let's get into it. Before we can even decide if BTC is safe, we kind of need a baseline, right? A working definition of safety. When you think about traditional safety in finance, maybe federally insured savings accounts or conservative government bonds, even some really stable blue chip stocks, that definition is all about predictability, stability, low volatility.
Capital preservation, primarily.
Right. And that framework, well, it just breaks down almost immediately when you try to apply it to crypto, doesn't it?
Completely. It fails because it doesn't capture this fundamental tension we mentioned, the battle between price volatility and long-term resilience.
Explain that a bit more.
Okay, so in traditional finance, if an asset jumps around wildly in price day to day or month to month, it's instantly flagged. High risk, unsafe, don't touch it if you want stability.
And that short-term volatility is Bitcoin's most famous or maybe infamous characteristic.
Infamous is probably right for many.
It's absolutely true. I mean, our data clearly shows BTC is known for these crazy price swings, 20, 30, sometimes even 50% within just a few months.
Unthinkable in traditional markets for a safe asset.
Yeah, if your 401k or your savings account did that, you'd be panicking, right?
Right.
So by those traditional metrics, the ones that prioritize keeping your capital steady and maybe earning a small, stable yield, Bitcoin is absolutely not a reliable short-term store of value. Period.
Period. No argument there on the short term. But, and this is the fascinating part, there's this counter-narrative, this historical resilience that traditional finance frameworks just don't really have a category for.
Meaning its ability to bounce back.
Exactly. Look at the history. The major crypto market crashes, you had 2013, where the price dropped, over 80%?
Devastating at the time.
Then the 2017 crash after that huge bull run, the correction in 2021 after the pandemic boom, and the really severe bear market of 2022 with the FTX collapse and everything else.
Okay.
Bitcoin has, historically speaking, recovered from every single one of those catastrophic drawdowns. So far, at least.
It finds a new bottom and eventually clungs back.
Right. And this suggests a completely different kind of long-term stability. It's not built on its day-to-day price, which is chaotic. It's built on something deeper. Its fundamental network structure, the protocol itself, its scarcity.
Okay, that's a critical point. And it brings us to another really important distinction the sources make about security. We have to separate the asset itself, the core Bitcoin protocol, from the infrastructure around it, the user layer.
Yes, this is absolutely the crux of the safety argument from the pro-Bitcoin side. The fundamental technology, Bitcoin's core blockchain ledger.
Yeah.
It has never been hacked.
Never. In its entire history.
Not once. Not in a way that matters. No flaw has ever been found or successfully exploited to allow someone to, say, double spend coins or just create fake Bitcoin out of thin air. The core ledger is intact.
How do we measure that security getting stronger?
Well, we can look at the hash rate growth. That's a key metric our sources point to, showing how the computational security of the network has just exploded over time.
Okay, for listeners maybe less familiar, can you quickly break down what hash rate is and why its growth matters so much for this safety discussion?
Sure. So hash rate basically measures the total combined computing power that miners worldwide are dedicating to processing transactions and securing the network. Think of it as the network's defense budget in computational terms.
The more power, the harder it is to attack.
Precisely. And the sources show this power has grown exponentially to actually stage what's called a 51% attack, where some malicious actor tries to gain control of enough computing power to rewrite the transaction history.
Which would be catastrophic.
It would, but the cost to do that now would be astronomically high. We're talking likely billions of dollars per day just for the energy and hardware. It's become financially impractical for any rational actor, and any attempt would likely be detected very quickly.
So higher hash rate means more security.
Much more security. It makes the network incredibly robust at its core level.
Okay, so the core asset, the protocol level, is secure. It seems like a strong argument. But the problem is how we as investors or users actually interact with it, right?
Exactly. The risk shifts entirely when you move up from the protocol to the user layer.
Things like personal wallets.
Personal wallets, yes, but even more commonly, the centralized exchanges where most people buy and hold their Bitcoin. These points of access and custody, they have been hacked repeatedly.
That's where the big headlines come from.
That's where the perception of risk really takes root for the average person. It's not the blockchain itself failing, it's the platforms built on top of it.
So we're forced to recognize this critical finding from the sources.
Yeah.
The asset, Bitcoin itself, is mathematically secured at its foundation. But the system of access, how you buy it, sell it, store it, has historically been vulnerable.
Prone to human error, mismanagement, outright fraud sometimes, and the risks inherent in any centralized system.
Which really forces us to redefine safety, doesn't it? It's less about guaranteed price stability.
And much more about protocol integrity, the reliability of the code, and critically, your ability to actually maintain control over your own private keys. Self-custody becomes a huge part of the safety equation. Okay, so let's shift gears slightly. Let's move beyond the noise of the daily price swings and really focus on those qualities that give Bitcoin its hard money status, according to proponents.
These are the characteristics people point to as its inherent safety mechanisms, the things that don't really care about short-term volatility.
Exactly. And the most fundamental one, the one that makes it so different from traditional money, has to be scarcity.
The fixed supply.
Precisely. Unlike government-issued fiat currency, which can theoretically be printed infinitely.
And often is.
Right. Bitcoin has a mathematically fixed and verifiable supply cap. Only 21 million Bitcoin will ever exist. Full stop.
And this principle, this hard money idea, is often cited as its #1 intrinsic safety feature, especially against inflation.
Absolutely. Think about it. In a world where central banks globally have engaged in unprecedented quantitative easing, basically creating trillions of dollars, euros, yen out of thin air.
Devaluing the existing currency.
Yes, diluting the purchasing power of money held by citizens. Bitcoin's absolute mathematically enforced scarcity offers this predictable anti-inflationary property that, while traditional assets, even ones considered safe, like bonds, often lack because their value can still be eroded by inflation.
What's the mechanism that actually ensures this scarcity is maintained over time? And why is that structure considered so much more compelling than, say, the US dollar, which is backed by the government?
The core mechanism is called the halving. It's built right into the Bitcoin code. Approximately every 4 years, the reward that miners receive for validating new blocks of transactions gets cut in half.
So the rate at which new Bitcoin is created slows down over time.
Exactly. It's a predictable, programmed supply shock that happens automatically. This makes the inflation rate of Bitcoin completely transparent and mathematically guaranteed to decrease over time, approaching zero as we get closer to that 21 million cap, estimated around the year 2140.
Contrast that with fiat.
With fiat currencies, a central bank can just decide, sometimes overnight, to inject trillions into the system based on economic conditions or political pressures. There's no mathematical certainty. For many people who are worried about long-term currency debasement, that programmed scarcity of Bitcoin, that freedom from arbitrary inflation by decree, is the ultimate safety feature they're looking for.
Okay, scarcity is one pillar. Then there's decentralization. We hear that word thrown around constantly. What does it mean practically? How does the fact that there's no CEO, no central company running Bitcoin translate into actual safety for someone listening, especially when we consider a government could theoretically try to ban it?
That freedom from third-party control is absolutely crucial. Decentralization essentially means there's no single point of failure.
Technically or politically?
Both. Technically, the network runs on thousands of independent computers, nodes, all over the world, all validating the same ledger. You can't just shut down one server and kill Bitcoin.
And politically?
Politically, if a powerful government, say the US or China, decides to ban Bitcoin, they can certainly make it difficult to use within their borders. They can target exchanges, miners, maybe try to block access. But they cannot shut down the global network because it doesn't reside in any one jurisdiction.
So it offers resistance to censorship or seizure.
Exactly. If you have deep concerns about the stability of the traditional global financial system or the long-term solvency of government-backed debts and currencies, Bitcoin offers this kind of escape valve. It's mathematically secured, globally distributed, and highly resistant to censorship or confiscation, assuming you control your own keys. For some, that's the definition of safety.
We really can't discuss this inherent safety without talking about real-world adoption, can we? Because adoption feels like this powerful, maybe irreversible form of validation. It takes Bitcoin out of the realm of just a speculative tech experiment.
And grounds it as something people and institutions are actually using and valuing as a store of wealth.
Right. Look at corporate conviction. That seems to speak louder than just retail enthusiasm.
Definitely. Our sources point directly to MicroStrategy as the prime example here. They've systematically accumulated over 200,000 BTC. It's now their primary treasury reserve asset.
Holding billions of dollars in something so volatile, that must have required incredible conviction.
Imagine the boardroom discussions. Their strategy basically confirms they view Bitcoin not just as an investment, but as a superior long-term inflation hedge compared to holding depreciating cash or even low-yield traditional instruments.
And their bet has paid off so far.
Massively. Their position is now up billions. This shows that major publicly traded companies are willing to treat Bitcoin as a legitimate treasury asset. They believe it offers a unique kind of long-term safety from currency devaluation. That's a powerful signal.
And perhaps the most radical validation we've seen is from a sovereign nation, El Salvador. They adopted Bitcoin as legal tender back in 2021.
A hugely controversial move at the time.
Extremely. But critically, our sources confirm that while they definitely endured severe initial volatility, their holdings were underwater for quite a while and faced immense global criticism, particularly from the IMF.
They held on.
They held on. And they've reportedly begun profiting on their overall Bitcoin investment after the recent market recovery and subsequent bull run.
That El Salvador example really highlights both the geopolitical risk and the potential reward. When they made that move, the established financial powers questioned the stability, the safety, the wisdom of it all.
They were warned it could destabilize their economy.
Yet, by sticking with it and seemingly benefiting from Bitcoin's long-term resilience, they're sending a very powerful signal. Here's a nation-state implicitly trusting Bitcoin's fixed supply as a tool for, potentially, national wealth preservation and economic stability outside the traditional dollar system. That's a profound validation that retail investors probably shouldn't ignore.
And this corporate and sovereign adoption is mirrored, maybe even enabled, by growing institutional recognition. This feels like the biggest indicator recently that Bitcoin is gaining safe exposure for more mainstream investors.
Absolutely. The rise of regulated custody solutions companies dedicated to securely holding crypto for big institutions and the huge participation from Wall Street. Specifically, the surge in institutional inflows into the spot Bitcoin ETFs. That is a critical measure of perceived safety.
What does the creation of a spot ETF actually mean for the average investor's safety?
It means two really important things. First, and most obviously, you can now get exposure to Bitcoin through your regular traditional brokerage account. No need to sign up for crypto exchange you might not trust. No need to figure out self-custody if you don't want to. It's familiar territory.
Lowering the barrier to entry.
Massively. But second, and maybe more importantly for the safety discussion, these ETFs are subject to significant regulatory oversight, typically by bodies like the SEC in the US.
Meaning rules and protections.
Yes. They often require the fund managers to use high-grade institutional cold storage solutions for the underlying Bitcoin, maintain substantial insurance policies, and adhere to strict reporting standards.
So let's be clear. An ETF doesn't make the Bitcoin itself less volatile, The price will still swing wildly,
Correct. The underlying asset is the same.
but it makes the access to that asset and the custody of that asset dramatically safer for millions of investors who are used to and trust the traditional regulated financial system.
Precisely. It takes this raw, decentralized, sometimes intimidating asset and packages it into a digestible, regulated, and often insured financial product. This significantly lowers the risk profile associated with that third-party failure. The exchange hacks, the mismanagement, which, as we identified, is arguably the primary source of actual investor losses and risk historically.
This is where it gets really interesting, I think. If the core network is mathematically secure, never been hacked, if the supply is fixed and predictable, and if big institutions are now piling in through these regulated wrappers like ETFs, why does this perception of extreme risk still cling so tightly to Bitcoin?
It's a great question.
What are the factors outside the Bitcoin code itself that continue to undermine investor confidence and make people hesitant?
It's because these external factors, these real-world friction points, often overwhelm the theoretical safety of the network for the average investor, at least in the short to medium term.
And the biggest danger, the one we see confirmed again and again in the source material, seems to be external custody risk.
Yeah.
Basically, the risk of the intermediaries failing.
Yes. This really brings up that crucial question. Is the primary risk the asset itself, or is it the people and the platforms that are holding it on your behalf?
Let's look at the classic case studies our material provided. Mt. Gox. Back in 2014, that was devastating for early adopters, but it's really important to understand why it failed, isn't it?
Absolutely critical. Mt. Gox wasn't a failure of the Bitcoin protocol. It perfectly highlighted the immense danger of trusting centralized custody, especially back when security standards in the crypto space were, frankly, immature.
What actually happened?
Billions of dollars worth of Bitcoin were lost stolen, effectively. Not because the Bitcoin network hiccuped, but because the centralized Mt. Gox exchange itself failed catastrophically. It seems to have been due to incredibly poor security practices, essentially terrible management of the private keys that controlled customer funds.
So for the investor who trusted Mt. Gox, the loss was total. Their Bitcoin was gone, even though the Bitcoin protocol itself was humming along just fine.
Exactly. The protocol's integrity didn't help the user whose funds were on that specific failed platform.
Okay, but let's fast forward. If the core asset has never been hacked, why did the price of Bitcoin still crater after much more recent events, like the collapse of FTX in 2022? Wasn't the market punishing Bitcoin itself for the failure of a centralized company?
That's the core contradiction playing out in real time. The FTX collapse provides an even clearer distinction. This wasn't even primarily a hack. It was spectacular exchange mismanagement, alleged fraud on a massive scale, and a complete lack of internal controls. Again, nothing to do with a technical failure of Bitcoin's code.
So why did the price dump so hard?
Because the resulting market panic was immense. It created this cascade effect. Trust in the infrastructure of crypto collapsed overnight. And even though Bitcoin wasn't the cause, that fear inevitably spilled over and dragged its price down dramatically.
So the market still sees Bitcoin as highly correlated with the health of the overall crypto ecosystem.
Very much so, especially during crises. It underscores that third-party risk, the counterparty risk of trusting an exchange or custodian, is perhaps the single biggest ongoing threat to investor safety in practical terms.
The old saying, not your keys, not your coins.
It sounds cliche, but history keeps proving it right. If you don't personally hold the private keys to your Bitcoin, you are relying entirely on the honesty, the competence, and the security of that intermediary. And history shows, from Mt. Gox to FTX and others, that reliance can be utterly catastrophic.
Okay, so custody risk is huge. Beyond that, we have these, could a major government realistically ban Bitcoin entirely?
A coordinated global ban seems unlikely given its decentralized nature, but a sudden, broad regulatory crackdown in a major market like the US or Europe, even if politically difficult, would almost certainly have a severe negative impact on price discovery and liquidity in the short term. This creates a kind of systemic risk that no single investor can really mitigate through just holding their own keys or having a long-term strategy. It's external pressure.
And finally, there's this pervasive influence of the broader market narrative and, well, the macroeconomy.
Yes, the narrative and macro dependence. Despite the whole digital gold aspiration, the uncorrelated asset idea, the reality so far is that Bitcoin's price is still highly sensitive to overall macro cycles.
Like interest rate hikes.
Exactly. Changes in interest rates flows into risk assets generally, global economic fear or optimism. Bitcoin often trades more like a high beta tech stock than like digital gold during these periods.
And it's sensitive to news and sentiment, too.
Very much so. Our sources cite Google Trends data, for example, showing that searches for phrases like, "Is Bitcoin safe?" absolutely spike immediately after major negative news events, a big crash, an exchange failure like FTX.
Fear drives searches.
Fear drives searches, and often fear drives selling. It demonstrates how closely the price is still tied to public perception, to media narratives, often driven by FUD fear, uncertainty, and doubt, and just general market headlines. The asset hasn't yet fully decoupled from the wider economy or from sentiment swings to be considered a truly safe, uncorrelated hedge by the majority of the market. Its price movements often still mirror those of other high-risk assets.
Okay, so we've got this complex picture. Secure protocol, risky intermediaries, regulatory clouds, macro sensitivity. What does this all mean for the individual investor, the person listening right now, maybe trying to decide if they should put some money into Bitcoin?
Yeah, how do you navigate this?
The sources seem to suggest that safety, in the end, depends entirely on who you are as an investor and, critically, how you approach the asset. It's not a one-size-fits-all answer.
That is absolutely the essential takeaway here. Safety in Bitcoin is entirely personalized. It has to be defined by your specific financial goals, your tolerance for risk, your investment strategy, and crucially, your time horizon.
So we need to break down the risk profiles based on different types of investors, using the historical outcomes from our sources as a guide.
Exactly. Let's start with the group that historically has been rewarded the most, assuming they had the stomach for it. The long-term investor, the HODler.
ODADL, hold on for dear life.
Right. Those investors who are committed to holding Bitcoin through its incredibly punishing volatility cycles, they have, as a group, been historically rewarded, provided they stick to a disciplined approach, perhaps like dollar cost averaging, buying regularly regardless of price.
Why does that work for them?
Because their risk tolerance for that short-term volatility is just inherently high. They're not focused on the price next week or next month. Their focus is on the multi-year cycle, maybe even the decade-long picture. They believe in those fundamental hard money principles we talked about, the scarcity, the decentralization, the potential as an inflation hedge.
So for them, a 50% price drop isn't necessarily a sign that Bitcoin is unsafe.
For a true H dealer, a 50% drop isn't a reason to panic sell. It's often seen as a temporary drawdown, maybe even a buying opportunity, in the longer-term pursuit of appreciation against inevitable fiat currency expansion. Their definition of safety is rooted in the long-term resilience and the fundamental properties of the asset, not its short-term price stability.
Okay, now let's contrast that sharply with the other end of the spectrum, short-term traders.
Yes. Short-term traders are facing arguably the highest risk-reward ratio imaginable with Bitcoin.
Why so high risk?
Because of that extreme short-term volatility we keep mentioning, if you're trying to make quick profits by timing the market, Bitcoin's tendency to swing 10, 20% in a day or a week can be brutal.
Especially with leverage.
Exactly.
Yeah.
Compounded by the common use of leverage in crypto trading, those swings can wipe out an entire position almost instantly. For this group, playing the short-term game, Bitcoin is arguably one of the least safe assets they could choose. It's pure speculation, not investing for safety. The network's long-term integrity is almost irrelevant to them. Their time horizon demands a stability that Bitcoin simply does not offer.
Okay, what about the big players then? The institutions.
Yeah.
They seem to be increasingly involved, but how are they approaching safety? They can't just HODL like an individual might.
Right. Institutions have different constraints. They seem to be achieving safer exposure primarily through two main avenues we've touched on. First, using those regulated vehicles like the spot ETFs, that provides regulatory clarity and outsources the custody headache.
And the second,
For direct holdings, they use high security, often insured, third-party custody providers specifically designed for institutional needs. These are not your typical retail exchanges.
but they face other risks, right?
Yes, they expose themselves to a different, very significant type of risk, reputational risk. Think about Tesla's big $1.5 billion BTC purchase back in 2021.
That made huge headlines.
Huge headlines, but it also exposed them to intense scrutiny from shareholders, analysts, and the media. They constantly had to justify holding such a volatile asset on their corporate treasury.
And they ended up selling some of it later.
They did sell a portion later that year, which really demonstrates the calculated corporate risk tolerance required. Institutions aren't just managing market risk, they have to manage public perception, shareholder relations, and potential regulatory scrutiny just as carefully. Their perceived safety comes from being able to manage and justify that volatility to their stakeholders.
Okay, finally, let's talk about everyday users. Maybe someone who's convinced by the long-term HODL argument, but is worried about the custody risks we discussed. How is their safety profile improving as the ecosystem matures?
This is a really positive trend. The technology is definitely improving the safety options for individual users, specifically allowing them to mitigate that crippling third-party risk we saw with Mt. Gox and FTX,
How so?
primarily through tools like hardware wallets. These are physical devices that keep your private keys completely offline, making them immune to online hacking attempts. They put the control and the responsibility squarely back in the user's hands.
And things like the Lightning Network.
The development of Layer 2 solutions like the Lightning Network also helps. It allows for faster, cheaper, smaller Bitcoin transactions, making it more practical for everyday use without necessarily having to trust a third party for every single payment.
So the tools are getting better, making self-custody more feasible.
More accessible and practical, yes. It fundamentally shifts the risk. Instead of trusting a potentially fallible centralized platform, you are trusting yourself to manage your keys securely. That's a different kind of risk, requiring education and diligence, but it eliminates the counterparty risk.
Are we seeing people actually do this,
Yeah.
moving away from exchanges?
Yes, the market metrics seem to reflect this growing confidence in self-custody. Our sources mention analyzing exchange outflows versus inflows. There's often a visible trend, especially during uncertain times, of large amounts of Bitcoin being moved off centralized exchanges and into private wallets. This signals a growing desire among investors to take control and manage their own risk directly.
Okay, so wrapping this section up, it really comes back to the individual listener, doesn't it? The
Yeah.
ultimate question you have to ask yourself is intensely personal. What is your definition of safe when it comes to investing?
Is it steady, stable value, maybe protected by government insurance, like a savings account?
Yeah. Or is it the potential for significant long-term growth, underpinned by verifiable scarcity and proven technical resilience, even if it means enduring wild short-term swings and taking on personal responsibility for security?
Your answer to that question really dictates whether Bitcoin fits your personal risk profile and your definition of safety. Now, if we zoom out a bit and connect this discussion to the bigger picture, the perceived safety of Bitcoin isn't just about Bitcoin itself. It's actually crucial for the entire developing digital asset ecosystem.
How so? Why does Bitcoin's safety rep matter for, say, DeFi or NFTs?
Because Bitcoin fundamentally acts as the market's foundational layer. It's the oldest, the biggest, the most well-known crypto asset. It's the market's primary proof of concept for blockchain technology and decentralized value.
It's the gateway, right? It's the first thing most people encounter. If the institutional world and the broader retail world don't trust that foundation, that first step,
Why would they ever feel comfortable exploring more complex or newer areas like Web3 gaming, decentralized finance protocols, or digital identity solutions built on blockchains?
it sets the tone. It's like the trust layer for the whole decentralized dream.
Exactly. Bitcoin serves as that fundamental gateway asset into the broader world of Web3 and digital assets. If BTC is eventually widely deemed safe, or at least stable enough, or perhaps just verifiably resilient after surviving multiple crashes, major hacks of intermediaries, and ongoing regulatory challenges,
That confers legitimacy onto the whole space.
it absolutely confers legitimacy on the entire ecosystem. It helps establish a baseline of trust and understanding that can then pave the way for more mainstream adoption of other crypto technologies. But conversely, if the foundation, Bitcoin, is constantly perceived as dangerously unstable or fundamentally unsafe,
Then everything built on top or alongside it looks shaky too.
it shakes confidence in the whole experiment, and mainstream adoption stalls, or at least slows dramatically.
Okay, besides being the gateway, the other major narrative driving its perceived safety, especially among macro investors, is this idea of digital gold. Bitcoin as a potential hedge against inflation, against unstable fiat currencies.
Yes, this is a very powerful narrative, especially post-pandemic with all the money printing we saw globally. But it's a narrative that is still being heavily tested in the real world.
How does it stack up against actual gold so far?
Well, the volatility index comparisons that our sources provide show it's still pretty difficult for Bitcoin to truly stand shoulder to shoulder with physical gold as a consistent safe haven asset yet.
Why not?
For instance, during periods of sudden economic turmoil or market panic, physical gold often remains stable or even rises as capital seeks safety. Bitcoin, however, as we noted earlier, often still falls sharply, along with other risk assets like tech stocks during those initial shocks.
So it doesn't always act like a safe haven when you might need it most.
Not consistently, not yet. To truly fulfill that digital gold role in the eyes of traditional finance and be considered safe in that macro context, its correlation with traditional risk markets probably needs to decrease significantly over time. It needs to demonstrate that decoupling more reliably.
But is it acting as a hedge in some places?
That said, its performance against collapsing or rapidly hyperinflating fiat currencies in certain specific global jurisdictions, think Turkey, Argentina, Nigeria, is already validating the hedge narrative for people living under extreme economic instability. For them, Bitcoin's volatility might look preferable to the guaranteed depreciation of their local currency.
So its safety as a hedge is context dependent.
Very much so. It depends on what you're hedging against.
And looking at the flip side again, we have to consider the consequences if this safety perception fails to solidify. What if regulatory bodies continue to view it as fundamentally too volatile, too risky for the mainstream financial system?
Well, if Bitcoin isn't successfully established and widely seen as a reasonably safe institutional-grade store of value,
Yeah.
if Wall Street exposure remains limited to just a tiny fraction of global capital, it definitely acts as a brake.
A break on what?
It dramatically slows down the potential mainstream adoption of all forms of crypto and Web3 innovation globally. The regulatory barriers would likely remain high, institutional investment would stay cautious and peripheral, and the average retail user base will continue to be plagued by fears about custody risks and those wild price swings.
So ultimately, Bitcoin's perceived safety isn't just about its own price.
No, it's really the market's proxy for the perceived viability and safety of decentralized finance and digital assets writ large. Its success or failure in achieving that safe asset status has ripple effects across the entire emerging industry. Hashtag tag outro.
Wow. That was an incredibly detailed deep dive, really laying out the data, contrasting that amazing resilience of the protocol with the undeniable risks in the ecosystem around it.
That's a complex balance.
We started by asking that seemingly simple question: is Bitcoin a safe investment? And I think we've synthesized a highly nuanced answer. The short version is, Bitcoin is absolutely not safe in the traditional sense that we think of for bonds or insured savings accounts.
Not at all. It offers zero short-term price stability, no government insurance, none of that traditional safety net. But, and this is the crucial final nuance from our analysis, as a long-term asset, one defined by its absolute scarcity, its decentralization, and a core protocol that has demonstrably never failed in over a decade. It may, in fact, be the safest long-term bet available within the inherently volatile and disruptive world of digital assets and Web3.
So the safety depends on the context.
Entirely. The real dangers, the things that cause actual losses, seem to lie not in the Bitcoin code itself, but in your chosen time horizon, your investment strategy, how you choose to hold it, and your personal security practices.
Which leaves us with a final thought for you, the listener, to consider, based on everything we've reviewed today that proven long-term resilience, the undeniable institutional validation through ETFs, the perfect security record of the blockchain itself.
But also the history of exchange failures and the ongoing risks.
Right. Knowing that the core code seems perfect, but the human systems built to access it are historically flawed, perhaps the real question moving forward is this: can the safeguards, things like the regulated ETFs, better hardware wallets, the whole self-custody movement, can they mature fast enough and become user-friendly enough to make the user layer effectively as secure and trustworthy as the underlying network itself?
That seems to be the key challenge for widespread safe adoption.
Absolutely.
Yeah.
And hey, if you found this deep dive helpful, if you enjoyed this breakdown on whether Bitcoin is safe to invest in, please take just a moment to engage with us.
It really does help the channel.
It absolutely does. Subscribing to the channel, leaving a comment below with your thoughts, and hitting that like button might seem small, but it genuinely helps support us. It boosts our visibility in the algorithms, and that lets us keep creating more of this kind of in-depth crypto content for you.
We appreciate the support.
We really do. So drop your thoughts below. Given everything, do you personally believe Bitcoin is becoming safer than maybe even gold as a long-term hedge? Or is it still fundamentally too risky for your own portfolio? Let us know. Thanks for tuning in to Deep Dive.